I had left the payback, which you all are probably familiar with, as a general business calculation. People don't like it for a lot of reasons, but it's often very good to know it, particularly when you're trying to sell somebody a product. To figure out how many months it takes to pay this back, you already have a clue about that because your multiple of the proposed solution is 13 times, which means, and since there are 12 months in a year, you already know that there's less than a month's worth of payback, and that alone is probably sufficient. But to be precise, let's take the number of days in a year, multiply it by the number of times we get divide it, by the number of days in our payback, and that's the number of days it should take to pay it back. And to figure out what that is in terms of 30-day months, it's 0.9. Gee, what a shock. So you can proudly claim that this solution has a payback of less than 1 month, and that is pretty compelling as a customer value proposition. Okay, so to create the income statement, we are going to first start by going back and taking advantage of the work we've already done. We've already done revenues. In fact, we've done most of these numbers in the monthly budget, so I'm just going to go back here. Having put an equal sign here, I'm going to go back to the monthly budget and pick that up off of our full year numbers. Full year revenues for the first year projected to be 6.45, which get rounded here. Cost of sales, we're going to do exactly the same thing, and again, this is going to be delightfully boring because it's going to simply go back and do this with every single one. And we're unfortunately going to have to go back and do the same exercise with the second year. So SG&A we pick up off of the full year number. Nice that we're preserving the convention of recording. Wait a minute, I don't want to go straight to pre-tax income. I'm going to calculate that on this page just because it sounds like fun. So for the second year, we'll go back and do exactly the same thing with the second year projections. Second year projections are 14.7. You can see here that it's easier to get a broad picture of what Fred is actually forecasting when we go from a monthly model, which is a bit detailed, to an annual model, which is much more aggregated. And then the SG&A I will pick up off of the monthly budget there. And I think we have calculated what we need to calculate off of the monthly budget. Pre-tax income, I'm going to calculate here. It's going to be the sum of gross margin and SG&A. That will be true for year 2 as well. And then because we have a explicit set of projections in our assumptions for the annual model for years 3 through 5, I'm going to work on getting those together here. So in my third year, I'm going to take second year sales and grow them at a rate that has been provided and that we used above for forecasting unit sales, and that is 65%. Again, don't forget the absolute cell reference, close the bracket, and then you can simply copy that forward. I'm doing Control-C, Shift arrow, and then Command-V, and that gives us the revenues. Cost of sales is, I'm going to go back and check that assumption. Cost of sales is a percent, and it's notice that here it's entered as a negative number, so we don't need to enter that in our formula. I'm just going to copy that here. Obviously that's incomplete, but we know it's a negative number and it's a percent to sales, so all I need to do is multiply that by sales. Now I didn't capture the absolute cell reference, so I'm going to go here right in the middle of C11 and hit Command T. That makes it an absolute cell reference. I could actually type in $signs, that would work. But these shortcuts are easier once you've learned them. And copy that forward, and I have cost of sales, and then I'm going to simply sum these two. Ooh, that wasn't right. Something went dreadfully wrong here. I'm going to undo typing that incorrectly. I didn't hit the equal sign. So it should be the sum of these two lines. And I'm going to copy it forward. So that takes us from revenues or sales through gross margins. SG&A, again, I saw it up there, and it is entered as a negative number. So I'm going to click on it, make it an absolute cell reference, and then multiply it by revenues. Now I noticed that some of these are two-digit, are rounded to the second digit or to the hundredth digit rather than the 10th digit. I'm not really bothered by that, but to clean it up later, we probably are going to go through and make sure that these are all single-digit roundings. Again, because we did the absolute cell reference, I can do Shift arrow arrow and then Command V to copy. Everything I'm doing there, again, remember, can be done up here, and maybe I'll do it just to show. Now I'm going to copy this logic here using the menu function, edit, copy, identify where I want to paste it, and then edit paste, and that rolls that forward. Now tax expense is actually also given as an assumption, so I'm going to collect that from the assumptions section, and we don't have taxes in our monthly budget. We're not making any money in the first year, but here we are, and it's going to be 40%. I'm going to make that an absolute cell reference. And then I'm going to multiply it, since I didn't put the equal sign in earlier, I'm going to put it in here, times pre-tax income, and that should give me a negative tax expense. Now, those of you who understand the IRS and have done tax projections before know that, can see that there's a small problem here, and that is that our model appears to project that in year one, our tax expense is going to be negative, that perhaps the IRS will give us $1 million back because we lost $2.7 million, and their rate is, in this case, 40%. Of course, we're talking, when we talk about 40%, 40% is intended to be the aggregate tax rate of all federal, state, city, other entities who are taxing the company. But in fact, they don't do that. And this is actually discussed in the case as well, and there's an exhibit in the case which walks through the tax logic that is shown here in the model. But for accounting purposes, that fiction is most often actually maintained, so that the net income reflects a negative tax expense. And to get the cash flow implications of that right is going to require a little bit of work. Now, to get everything uniformly rounded to a single decimal point, I played with the display zeros, made them all 2 decimal points, and then took them all back 1. That fills out the income statement. It was relatively simple, and all these numbers here show you the projected growth rates, and as you can see, our input projected growth rate of 65% looks fairly reasonable given that the second year growth rate. The first year growth rate is of course infinite, going from 0 to a positive number, and then the second year growth rate is 127%, and it tapers off in years 3, 4, and 5. Gross margin, which is 71% in the first year, grows to 81% in the second year, and then stays about that range going forward. I'll let you look at the SG&A and EBIT numbers as well, but you can see the EBIT margin, or the operating profit, or the pre-tax income, all of which are equivalent here because we don't have interest expense, tapers off at about 13%. Now here's the tax logic, and I refer you to the exhibit in the case, but let's walk through it very briefly here before we go on to create the balance sheet. So in the first year, we've incurred a $2.7 million operating loss, and that means we add $2.7 million to NOL. And this logic, which is the minimum of 0 or D59, in other words, it just picks up negative operating profits, accumulates all additions to NOL in all the years. Now this is the way this will actually be taxed is it will be accumulated and applied to profits when they're earned. In this case, the company gets profitable fairly quickly, and you can see that a pre-tax loss of 2.7 gives way to a pre-tax profit of 2.2 in the second year. And we just want some logic which apply that 2.7 loss in the first year to the 2.2 million in the second year, and then whatever remains, which in this case will be roughly a $500,000 NOL, gets applied against the pre-tax income in the third year, and then the tax rates get calculated off of that. And you can see here that's exactly what the logic does. Here's the NOL carry forward, which is 2.7 in the first year. None of it is applied in the first year because there's no profits. 2.2 is applied in the second year. $500,000 is applied in the third year, and there is no further profit. And then the cash tax paid is nothing more than the tax rate times the net of pre-tax profit and the NOL applied. I will let you walk through the logic for that, but that's the fundamentals of how it works.